Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. In this episode of the Moneymakers podcast, I'm delighted to have another opportunity to talk to Marcus Phayre-Mudge, who has been the manager of TR Property for many years and has worked on that particular trust even before he took over as manager from his predecessor, which I think was in 2011. So 15 years under the belt as lead manager of this trust, which, as many of you will know, invests in the equity of other property companies, including investment trusts and REITs, and has been the only trust of its kind for many, many years. So, Marcus, thank you very much for joining us again. You've just put out some results on your latest annual report. And if I got to pick out one word out of the many words that you've written about what's been going on in the property sector, I think I would pick out the word frustrated. Because some of the things you were talking about last time we spoke, you talk about effectively the steady progress that you've been making has been, quotes, blown away by the macro, or in particular by a certain individual called Donald Trump, who's twice in the last year made some significant differences to the macro outlook, shall we say, first with the tariff announcements and then with the Iran war. Have I got that right?
You have, Jonathan. You're, as always, spot on. You really have pulled out the single word description. And I think, yes, to reference the President of the United States is quite right, because our year was very much bookended, as you say, first by the tariffs in April 25 and then by the conflicts in Iran in March 26. And I think the frustration is really focused on the fact that we were just beginning, and it was certainly, I would reference the last bit of the year, if you start in sort of November, December, and moving certainly into January and February of this year, where we really began to see the benefits of both the improvement in the fundamentals of the market, but very much helped with the gentle breeze tailwind of the price of money coming down, a realization that inflation seemed to be under control, both the long end of the curve starting to come down, as well as the short end, because we were pricing in, the market was pricing in cuts in both the BOE and the ECB. But for us, also what was coming through was a realization from the market and investors that if you owned the right real estate, two things were happening. One, customers were bidding up to occupy that space. And it really didn't matter whether we were talking about super prime offices or whether we were talking about healthcare facilities or industrial units, all sorts, all across the whole range. But really that was because so little new kit has been built in the last decade. And there was a statistic that came out the other day that I think it's since 2018, construction costs are up 65%. I mean, it's a huge number. And there'll be many a development appraisal sitting on an eager, optimistic developer's desk. And each time they think they should kick off with the development, they realize that they've got to have another look at the costs. And it's gone up, and therefore they're only going to build this X, Y, or Z if they can achieve a rent which is now higher than they thought 6 months ago. And as a result, the risk-reward profile has just not been seductive enough. And therefore the result is we just haven't built enough.
Right. So you've got that supply constraint, as you pointed out, supply narrowing, and that normally would be positive. But then you've been hoping for some increase in demand on the other side, both of which would also be positive. Is it too simple to say that the channel by which Trump's interventions have affected the market is by virtue of the fact that we're no longer expecting interest rate cuts and the long end of the bond market has seen yields rising as well? So that is fundamentally a problem for the commercial property sector, is it not?
Yes, it is. Certainly from an investor perspective. From the occupier market, they still see what they see, which is that they've said to their agent, go and find me 50,000 square feet. And the agent's come back and said, right, here's your shortlist. There's 3 buildings. So that list hasn't got any longer or got any shorter. The question is simply, where the geopolitical issues manifest themselves onto the demand side rather than the investor side is where the corporate says, not sure what's happening. Everything's a bit cloudy out there, foggy, misty, not sure where my cost of goods is going or whether my customers are going, and therefore I'm going to withdraw from the market. Now, that part we haven't yet seen. And I think that the transmission mechanism to the investor market is very quick, because you're about to buy a building, you're going to borrow the money from the bank, and suddenly you find that the swap rate has moved up 60, 70 basis points, and therefore you must adjust your pricing to reflect that. So that's very immediate. But for the occupier market, it is a bit more deferred. It's a bit further down the line. But once it slows, then our experience is it slows for a period of time. If they make a decision to stay in their existing building or reduce their headcount or whatever, they're not going to suddenly turn around and turn that back on. Whereas the investment community, if we suddenly see the Straits of Hormuz open and the risk-free rate comes rattling down or whatever it may be, then we will see that reaction to asset values will be much faster. So we're running with these two separate, the wheels have got different gearing mechanism, I suppose, that one way to look at it. Just while I'm on that point, what's so interesting is even though the swap rates have moved up, and I'm sure we would get to this anyway, I know you'll ask the question, so I'm just jumping ahead a bit, is actually what's so fascinating for us is in normal conditions, you would then see margins widen because generally the cost of money has gone up. The lenders have become a bit more fearful, but that's not the case. There is plenty of debt availability, which is another reason for us to feel positive that should the geopolitical risk reduce, we will see that transmission mechanism back into capital value growth manifest itself quite quickly.
Okay, so you don't have any control over what's going on in that wider macroeconomic sense. So let's take it in stages then. Where was the good stuff coming from in the first 11 months of the year you've just reported on? How was that being generated, the good returns you were generating until the Iran war? Where was that coming from and where is it now?
So that's a very good question. It was broad spread. Some of it was from M&A, where we were seeing either consolidation or private companies coming in and acquiring public companies that they felt were underpriced. I mean, that was less of a component compared to previous years, but it was still a feature. The second was that we were continuing to see strong rental growth and very high running yields from sectors that were essentially a little bit out of favor. And so our biggest winner in those 11 months was actually European shopping centers, where you were seeing wage inflation ahead of indexation of wider inflation. You saw a consumer who generally has much less mortgage debt, we're talking about France, Germany, Spain, than their UK equivalent. No one, of course, is going to build another shopping center because there's too much space as a consequence of a lot of retailing moving online and omni-channel. But overarching that is quite a slow structural shift to online retailing. So, for example, in Italy, in Spain, and to an extent in France, we are still a very long way below the 35% of retail sales being online, which is where we are in the UK. So to give you an idea, Italy is closer to 15 or 16 than anything else. So, people are going to shopping centers to shop, and there's only a limited amount that they're buying online. So we're seeing rental growth and tenant demand across the piece there. In Scandinavia, where we always laugh about the fact that the Swedish property companies, the nation that brings you the safest car, brings you the scariest property company because they're always the most leveraged and they operate with a lot of short-term debt. So they were really big beneficiaries of the short end of the curve coming down. So they were winners for us. German residential traditionally has a very high correlation to bunds. They're seen as very safe, relatively low growth. And they'd had a horrific time during 21 and 22 when interest rates obviously went from zero to a lot higher across Europe. And then we were beginning to see that come down. So they were winners there. And then industrial logistics just continued. The rate of rental growth had slowed down post-COVID. What was going on in the immediate aftermath of COVID was unsustainable double-digit growth. That had come down, and we'd seen the market react to that. A lot of share price corrections, the likes of Segro going from £14 to £7. And therefore, they enjoyed a good recovery because they're still offering rental growth. And at the end of the day, that's what equity markets want. They want growth. The way we describe ourselves is we're the value end of the equity trade or we're the growth end of the bond trade, because real estate offers you income that is essentially tied to economic growth. So it was very broad spread. The sort of disappointments, I suppose, last year, I would particularly call out student accommodation, which was really a combination of the top-down picture changing, a realization that actually there are going to be fewer students prepared to take on that amount of debt, and the cost of accommodation, why we'd be so attracted to the sector for the previous decade, this is purpose-built student accommodation for your listeners, is because the rental growth have been so strong, averaging 4, sometimes 5% per annum. But of course, that had then been met with a supply response, but then there'd been a sort of constant increase in the number of students, and then a realization that suddenly this was probably a non-sustainable situation, and you were going to get what you always get in these situations, which is people gravitate to the better universities, and those that are most indebted or submarkets that have oversupply, you see obviously growth being removed and rents actually potentially falling. And yet in the midst of all of this, we saw Unite, the biggest listed player in student accommodation, decide to acquire a business called Empiric, which specializes in postgrads. And that just looked to us to be a very, very strange transaction, because actually it was the postgrad market that had been suffering the most from this slowdown, particularly because it was a big focus on international students. And for some of those cohorts, it was going to prove harder to get to the UK or stay in the UK, or the incentive to stay was being reduced because you couldn't bring family members, etc. So we found that to be a very strange decision, and so did the wider market. I mean, the share price absolutely collapsed, not only on the news of that transaction, but then subsequently on the profit warning with their results. So that was a bit of a difficult. We did reduce our position significantly in the middle of that. So we took some of that pain, but we did also avoid some of it as well.
I guess the thing that interests me here is just taking a step back for a moment. Basically, you've pointed out more than once that the discounts at which traditional REITs trade are pretty wide by historical standards. They're not as wide as they were in 2008, but they're getting close. And it's been fairly persistent. So that suggests to me that there is a kind of fundamental issue, notwithstanding the positive points that you've made about the supply and demand. How do you explain that?
Given how rapidly the sector repriced in, say, January and February this year, when we were really feeling the sort of dual tailwinds, I think for me, we were up 14% in those 2 months. The sector was, and TR Props a bit more than that. It was a realization that the sector is heavily underowned. And we have been living through all growth equities are great and value equities are not to be owned scenario for quite some time now. And we are essentially a very small part of the equity market. It doesn't matter if you're looking at us as a percentage of the all share or of Euro Stock 600 or MSCI World Equities. The number is about 1.4, 1.5%. So we are very small. Yeah, and therefore easily forgotten. And we have a strange valuation metric. We should be earnings based, and we are increasingly returning to that. But many people have looked at it on an NAV basis. So I think we've been underowned, we've been underloved. And to be blunt, that's been justified. We're seen as a long duration leveraged asset class. And that absolutely is correct. So when rates move and the cost of money moves, we're going to suffer from that. The however is, and quite simply, why is the trust almost at maximum gearing in the light of everything that's going on? It is because of the fundamental market conditions and the fact that the listed companies, not all of them, but the vast, vast majority own very high quality portfolios in their respective subsectors. So you're not exposed to that secondary and tertiary market, which really has got some ongoing problems. But I think in terms of why the discounts, the 3 reasons. One I've mentioned, which is really about, we're just slightly forgotten about. The second is, and it is, I'm afraid, absolutely factual, that a net asset value, the valuation is an art, not a science. You're asking a firm of independent valuers to assess your assets, and no 2 assets are entirely the same. it's a backward-looking metric. So they are behind the curve on the way up and behind the curve on the way down, and all valuers have to accept that. And then for most of your listeners, they are sitting in the UK. We are probably the most blue chip, blue-blooded of the valuation communities. And when you talk to one of the big surveying firms that are global, the valuer sitting in London at CBRE or Knight Frank or Jones Lang, whatever, will be acting very differently to his equivalent sitting or her equivalent sitting in Frankfurt. And that's because the German model is to mark to model rather than to mark to market. So they very much see valuation as a smooth process rather than reacting quarterly. So you get a situation where, to us, the fact that German listed residential companies are currently trading at a 45% discount to their asset value, in inverted commas, doesn't worry us. It's not that they suddenly are incredibly cheap, because those NAVs aren't that accurate. Whereas in the UK, there are certain stocks where it's currently very hard to price. So if you own shares in a tiny REIT called Regional REIT, which owns tiny, very small lot size regional offices with an average lease length of 3 or 4 years, that's very difficult to price, very difficult to borrow money against, etc. So meanwhile, if you're trying to value SEGRO's industrial portfolio, in the Slough trading estate, etc., that would be incredibly accurate because there's been lots of evidence. So I think people are realizing that NAV is an art, not a science, and that it actually stands for not actual value, but there's shades of that. And then I think the third reason is that, and we map this very carefully, we model it comprehensively for all our companies. The fact of the matter is that most debt books are run anywhere between a revolving credit facility up to about generally 5 to 7 year money. Sometimes you'll see private placements that go beyond that, but generally that's the life of the duration of the debt book. And therefore, lots of these companies are refinancing now for 2020, 2021, 22 vintages where rates were so much lower. So you may have top line rental growth, you've got solid indexation coming through, but actually some of your new top line growth is being eaten up by the fact that your cost of debt has increased. So that is another feature. So not all of our companies are going to see what looks like stellar bottom line growth based on strong top line growth. Some of these companies have got this headwind. But then they're repricing it to remind investors it isn't the shock of 2021 and what was going, with the beginning of the Ukraine war and that inflation surge where we were coming from interest rates of 0 to 1, depending on which jurisdiction you were in. We are, of course, much, much higher than that now.
Right. So the marginal change is not so brutal as it was at that point.
Exactly.
If interest rates change or expectations change. So if these discounts exist for the reasons you mentioned, and the supply and demand picture is, I think, as you would suggest, not totally unfavorable, my conclusion sitting here might be, well, there's been a lot of consolidation in this sector. There's going to be still some more. Would that be right? And is that how you're going to make a living, as it were, at the margin now?
I think at the margin, there is still conducive reasons to see further consolidation, particularly in the sub 1 billion market cap companies. I mean, we are in a world where a huge amount of the wealth management community have themselves consolidated and amalgamated. And to get on list, as it were, for some of these big wealth managers and their central platforms, if they were starting with a clean sheet of paper, they would no longer be interested in a listed property company with a market cap of 500, 600 million, because they would need to own 10, 15, 20% of that company, and it's just not appropriate. So that's looking at it through one end of the telescope. The other is quite simply economies of scale. All the time you're looking for, if a company with a market cap of 500 million, it's got gross assets of 8 or 900 million, net, it might be 600, your rent collection. It's like, what's your gross to net on that? If you're collecting 35 million pounds of rent, but it costs you 7 million pounds to run your company, there will be a much larger business who can bolt on those assets and do it a whole lot cheaper. And the bottom line is, it is about earnings and earnings growth. And these cost ratios are crucial. So it's very hard for these very small companies to justify themselves. We don't necessarily want to see those assets or even those management teams, some of them leave the space, which is why we've been pushing for consolidation rather than privatization. But sometimes a private company with cheaper debt will just make an offer that no one can refuse. And obviously last year we saw that in the case of Blackstone and Warehouse REIT. Whereas in other cases, like Urban Logistics REIT, we saw London Metric acquire it for paper. We're very big shareholders. We were very happy to sign up to that. There is a possibility of larger scale amalgamation because to get globally relevant, we really only have a handful of companies in Europe that are globally relevant. And therefore, we may well see further consolidation. Having said that, there is a huge amount of investment grade real estate or high quality real estate, which is owned by private equity. And all private equity, they all at some point wish to monetize. They're all going to want to find an off-ramp for those assets. And they either sell it to another private equity player or into some secondaries fund, or they come and look at the listed market as an off-ramp. And, there are certain subsectors, multi-let industrial, data centers, retail warehousing, which I think the listed market would be very happy to look at IPOs.
Just a brief diversion into this. There are a couple of cases still out there, which I think I can mention, one of which is Aberdeen European Logistics Income, and that one is Picton. We talked about them a bit. What do you make of those two? Are you involved in those situations?
I'm involved in one of them, Picton. It's public. We are the largest shareholder of Picton. We own about 12% of the company. We did give a letter of intent for the transaction, which is so far only a non-binding proposal, but the board of Picton are minded to recommend it. That 2.4 announcement, just a bit of technical jargon, was about a month ago, a little over a month ago. We obviously had Picton's results this morning. So it was a little bit disappointing. It would have been a nice dovetailing because the difference between a 2.4 and a 2.7 and a formal bid should be roughly about a month because that's the time that everyone has a look at the detail they haven't already looked at prior to the strategic review. And I was hoping for something today. But anyway, I don't think there's anything untoward here, but that's still out there. ARIE, I'm not involved in the Aberdeen industrial vehicle. But why have I given the letter of intent? I've had a lot of questions about it because on the face of it, the price, because it's actually a consortium deal where London Metric are going to take some of the assets and the Schroeder REIT are going to take others. And it looks like it's a very large discount to the asset value. But for me, it's about the earnings accretion coupled with what is the market prepared to value those assets at when it was sitting in a standalone vehicle the size of Picton. And if we go all the way back to before the strategic review, the market wasn't valuing these assets at anything like the price at which this transaction will hopefully proceed at. But we're not losing the assets. They will just be essentially run in more efficient structures.
Okay, so Picton, is about 350 million market cap, something like that. And that's, in your view, not really the right size, basically, for today's markets.
No, we absolutely backed this management team and we dearly would like it to be larger, but they were unable to close that discount. They started successfully by selling assets and buying back shares. And then clearly the board chose to announce a strategic review because it must have received interest from other parties. And at the end of the day, you don't want to go into a 3-year runoff situation. Yeah, selling assets and buying back shares is absolutely the right thing to do when you're trading at such a large discount. But ultimately, if your discount doesn't narrow, in any consolidation trade, the value of your shares and the discount to the asset value, that is your currency. And you need to get that currency up if you want to be the acquirer rather than the acquiree. And that just wasn't happening. I'm afraid it just comes back to my original point that the institutional wealth community had, I won't say abandoned, but they just weren't attracted to these smaller companies. Now, listeners who are interested in the sector will go, hold on, Marcus, what about AEW REIT and Custodian REIT, who are, in some cases, even smaller? But when you look at the registers of those companies, they are heavily retail owned. And there is a whole cohort of perfectly sensible people who look at these businesses and go, I want to clip a 7.5%, 8% dividend from my little REITs. And, I'm happy to own them. And, in the case of, particularly the case of AEW, it trades incredibly close to its asset value. And it's entirely down to the fact that it has this very, very firm retail ownership. Personally, I think that you are to some extent converting capital into income. We are also a total return animal at TR Props, and stocks that are trading incredibly close to asset value are unlikely to be more attractive than those that are trading at very large discounts. So, I'm playing a relative game, so I'm not decrying those investors. And I know that Custodian tried to merge with another company that then ended up going into runoff, and I think that was a disappointment for them. I think they would have done better to have merged and got themselves a bit bigger as well. But again, that's a well-run REIT out of the Midlands, focuses on high-yielding secondary assets, and there's a perfectly good case for those if they're priced correctly. And that is an interesting business because the chap who runs that, Richard Shepherd-Cross, is a very good manager, and he turns over the assets a lot. So he's constantly helping the valuers understand what his stock is worth.
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. So you talked about, you see the potential for some property companies to come back to the listed market, if you like, or property assets come back to the listed market. Obviously, our listeners are mainly interested in investment trusts. I'd just like you to tell us what you think was the story or what was the problem with one investment trust recently, or not so long ago, came to market, which was Life Sciences REIT, which has turned out to be a bit of a disaster. What lessons should we be taking from that experience?
Yeah, well, I wrote a little bit about this in the annual report. For those who want to go to the trproperty.com website, in the annual report, there's a couple of paragraphs on this. I think the first point to make, Jonathan, is I didn't own the stock. So I have no axe to grind here. But essentially, it was just a combination of timing and hubris. Timing in as much as the money was raised at a moment where it looked like there was about to be a big surge in demand for life science and lab usage. Although actually what was happening was that VC funding, particularly out of the States, was actually pulling back from Europe at that time. But it slightly felt maybe a bit of a tail end Charlie on that. The problem, of course, with these externally managed businesses then raise a lot of capital where the manager is paid on the asset value and not necessarily on the performance, is that you get a misalignment. So they invested the money very quickly in a very broad range of assets. It was very strange to us. We felt, so obviously we look at everything all the time, and it was a disparate group, a mix of completed assets, partially let, some fully let, asset management situations where a building with a single tenant, but it had a cliff edge lease renegotiation a couple of years out, all the way through to a development site outside of Oxford, where the developer was busy building lab space, and essentially the REIT committed to complete these buildings, pay for them, and so they took all the leasing risk as well. So it was a sort of triple whammy because you were taking a brand new business with no assets, no history, a management team that was just being sort of flung together and taking on a huge amount of operational risk. And it just failed, quite simply. And the pound that you put in ended up being worth 34 pence. The frustration, I think, for investors who were in it as well was that the manager was being paid on the net asset value. So there was little incentive for that asset value to be brought down in line with the market. And yeah, that's always problematic. So yeah, I think investors did well for British Land to come out of the woodwork and buy it for part cash, part shares. So whilst it's a sad end, I think it was the best outcome that could have been hoped for by the time of the end of the life. And for us, it is genuinely disappointing because we don't want private investors or anyone to have a bad experience buying REITs. But I genuinely think we are unlikely, or if we do see any more externally managed REITs come to the market, they will have a number of guardrails that we have been long promoting. So 1-year notice periods, management fees partially paid in shares, and of course, fundamentally a fee based on market cap, not NAV, because the NAVs, as I said, they are an art, not a science. And it seems only fair that, and then of course, if you then trade at a premium, happy days for everybody. Shareholders are delighted and the manager gets rewarded for identifying a particular part of the market and trading at that premium.
Yes, I mean, I think there'll be more than one case of that, if you like, misspecification at the outset as far as a lot of alternative asset trusts are concerned, not just commercial property, but others as well. But that does seem to be being put right. I know I asked you this question last time, before we come back to your portfolio. What is the future for the investment trust sector in commercial property overall? I mean, you've hinted at some of the possibilities, some things coming back to market, but they may not be investment trusts in the purest sense. What do you think about that? Are you going to get more opportunities in this particular sector?
Well, obviously, I ideally hope so. I think that what we have seen in the commercial property space over the last decade is a realization, it's not just in the UK, it's across Europe as well, that the previous structures, which are now called in the UK PAIFs, so property authorized investment funds, which were open-ended, daily dealing and invested only in commercial property. It's a bit like us scratching our heads and thinking, God, we used to in the 70s drive around without seatbelts. I mean, it's a sort of bonkers construct that you would have a vehicle where the manager offered the investor daily dealing, but they only owned commercial property. And if all you listeners have bought and sold houses, let alone commercial property, you know how long it takes. So actually the sister fund to TR Property that I run is called Property Growth and Income, and it's an open-ended daily dealing fund that's 70% equity, 30% physical. And that's about the maximum physical you can have. And that fund has been daily dealing since 2005 and never closed to redemptions. And our strap line was literally open-ended daily dealing in physical property, 6 words that shouldn't be in the same sentence. So I think you're like, where are you going with this, Marcus? But the point is that that product has literally disappeared. And actually, the REIT structure, and you can look across the pond and the success that the REITs have in the US, where they are a very significant part of the commercial property market and ownership structure. And it's a bit like, if you ask any investment trust investor or manager, what's the best thing about investment trusts? It's the fact that they're closed-ended. It's the fact that the manager can carry on and run the assets safe in the knowledge that he or she doesn't have to liquidate overnight and return that money. So they can go into cash, they can have gearing, and it doesn't matter what your investment trust invests in. I know I'm teaching my granny to suck eggs here, Jonathan, because the listeners are all well versed. But in the property world, I think we are evolving and the REITs are maturing, and we are seeing markets of investors driving companies to focus on earnings and not on this loose concept of NAV. And when you look at the US, they only focus on earnings. They produce an asset value that's to help the banks understand broadly what they're underwriting, but the banks are only lending 30-40%. So it's not like they need to know down to the last penny. And it's all about earnings. And that's exactly what it should be. And that's what REITs should be providing. It's a growing earning stream, which then forms a part of your portfolio. We are never going to be in your growth bucket. We're always going to be in your value bucket. But there is a moment where you're at a party, and there comes a point where everyone looks around for the designated driver, the cautious Cuthbert, because the tech bros at the bar have finally had one too many. And therefore I am optimistic, because it comes all the way back to the fact that when you look at the vast majority of these REITs, it doesn't matter if you're looking in the US or in Asia or Europe or even here in the UK, we do own the top end of the piece of Toblerone. That's the really important part. That's the bit that's going to experience rental growth. And when you look at where real rents have gone over the last 10, 15, 20 years, it's been very modest in many sectors. The affordability, you talk to a tech giant, they want to be in a particular space, in a particular location, and they're prepared to pay for it. And whether it's in central London, whether it's £120 per foot or 130, makes not a figure difference. And we're seeing it in some respects in the value of some of these data centers. and the rent that these hyperscalers are prepared to pay. It is extraordinary, and that's maybe a short-term gold rush, but I'm just reflecting on what is priced in the market at the moment.
So I think overall, if we look at the sector, and I want to put your trust in there with that, basically the story seems to have been, well, in your case, you outperformed your benchmark very nicely. You did it again last year in a tough year. But basically, in sort of relative terms and in absolute terms, real estate has been sort of going sideways for about 5 years. If you look at it sort of from a longer term perspective, that would be fair, right? And I think the total return on your trust annualized is still around zero, roughly over 5 years, something like that. And that's not untypical of lots of others as well. And therefore, a lot of focus is going to be on the yield you are producing and whether it's covered or not. And your dividend is healthy. I think it's around 4.8, 4.9%, something like that, maybe even 5. It's healthy yield, but it's not fully covered. So if I'm sitting there as a shareholder in TR property, what am I thinking about the future from of my yield from your particular stock against this kind of market background?
Yeah, it's a very fair question, Jonathan. And the answer is that, as you remember from days of old, TR actually stands originally for Touche Remnant. And then, of course, we moved as a management team from Henderson in 2004 to Thames River Capital, telling Charlie and Johnny, the owners of Thames River, we only did so because we didn't have to change the name. That else was a little joke. Now, of course, even though Thames River is still manager of the trust, we like to say that TR stands for total return. And that's very much what my mandate is. I'm there to beat a benchmark that is a total return benchmark. Now, income is a crucial component of that. Now, I could easily build the portfolio so that it yielded me 7-8%, because there are plenty of property companies that will give me that. But I'm looking for total return. And therefore, as far as I'm concerned, and as far as the board is concerned, and if you read the comments by the chairman carefully in her statement, is that it is about dividend growth. And whether we are entirely covered or not entirely covered is not necessarily the key point here, because there'll be moments in the cycle where it is in the interests of shareholders and their total return for me to back companies that have chosen not to distribute their earnings for a period of time, but to hold on to them and to grow parts of their business through buying land, which they're bringing through for planning and enablement, etc., or businesses that are super high growth because they've stumbled on an opportunity, which means it's going to be very low yielding for a period of time, i.e. that the income growth is deferred hockey stick style. And I will do that. But the great thing is, not only do we have revenue reserves to draw on, and we have in the past decade, there have been times where our payout ratio has been 95, 96%, and other times when it's been 104 and 105. So you're filling the reserves when you need to on the basis you're going to use them in the future. But I think investors are realizing at the end of the day, real estate, fundamentally, it's always going to be an income producing asset. But at the same time, I don't think any shareholder would want me to push the trust towards an over-engineered income if it is at the expense of total return. So we're very much that dual beast, but the aim is still to make sure we can continue to progress that dividend payment in absolute terms.
Which in a sense brings us back to this issue of interest rates and so on. I mean, if your 10-year gilt is nearly at 5% or something like that, and you're yielding 5%, obviously you're investing in real assets, not in a nominal asset class, and the returns have not been that good over the last, say, 5 years, much better over 10 years, obviously. What part in your portfolio should that play? If you think about it as a total return instrument, we're back to this issue of how you file it away in your portfolio, what you call it, how you style it, and how you monitor it, what you think about it as it's going along. I guess investors in, say, your trust will be disappointed probably with the total return over the last 5 years. I'm sure they will be. But you would say to them that actually, even though we're starting with a situation where our yield is equivalent to the 10-year gilt or whatever, there is room for growth, and that's what you're going to deliver.
Yeah, I mean, you've almost made my speech for me. I would add the disappointment is well shared. After my house, my next largest exposure is to my ownership of TR property, which has all been bought with post-tax earnings. It's a much more difficult conversation with your teenage children who are explaining what a junior ISA is, and they're asking, what's it invested in? And then you start to look at your hands and your wife starts laughing because they're disproportionately owners of TR property as well. But then they give you a hug and say, don't worry, Dad, we're in it for the long run, which is the right answer, of course. But moving back to the point, absolutely, you're spot on that it is about where the starting point is now. And yes, I can explain and rationalize everything that's happened over the last 5 years to lead us to that zero return over 5 years. But we're looking from here forward. And we come back to that cost of development and the fact that so many of these listed companies, whether you think the asset value is 5% below the published number or 10% below, the fact is we're trading at much deeper discounts to that. More importantly, we are way below rebuild cost everywhere. And that's crucially important. So for us, it's picking those management teams and those balance sheets where they can get into these markets where there is rental growth and where they can capitalize on that. They can redevelop or refurbish or find exposure to that. And at the same time, we also are always going to have a cohort of the portfolio, which to some extent is long duration and it is very sensitive to that rate, but it's in assets that are basically needed at all times. And the obvious two are primary healthcare and supermarkets. And these supermarkets can afford to pay the rents that they're being charged. And as we're increasingly finding, they can even in some cases pay a lot more, particularly on the continent. So yeah, the frustration that's come right back to the beginning is all about the geopolitical risk, and I can't do anything about that. But I do feel confident about the rents that are being charged, the ability of our company's customers to pay those rents, and the need to want more and better quality space going forward and be prepared to pay more for it. And then we mustn't forget that if we do get, which we will inevitably have, a surge in inflation, almost like the snake that ate the rat, will pass through the system, even if the Straits of Hormuz was open tomorrow. We are already seeing that indexation numbers tick up. And remember, all of our rents in Europe are index linked. It's increasingly the case in the UK, but in Europe, it's all linked to a greater or lesser extent. So whilst we may suffer from rates remaining higher than we want, and we obviously had a base rate increase from the ECB and the market's pricing in one more from the BOE, we are still seeing that top line growth as well. So it's not a all negative situation. And I think that's important to remind everyone.
Right. And therefore, does that mean that you're going to be maintaining your kind of high level of gearing, which you say is pretty high by your own past standards? You'll be maintaining that into this environment because that reflects your optimism or bullishness or whatever you like to call it.
Yeah, I mean, it's a function of the fact that many of our stocks are below where they were at the end of March. And I think it's a fair assumption, although I am not a geopolitical specialist, I do think that we are maybe not the end of this conflict, but at least we're nearer a chance of there being some equilibrium than we were at the end of March. And today's news, I mean, who knows whether they're going to sign a peace accord in Geneva at the weekend, but it's interesting to see a wider market respond quite positively, and we'd be beneficiaries of that. We're up 2% today. Sorry to date this podcast, but it's Friday the 12th after the market close. So yes, I do feel positive. However, I absolutely am a custodian of shareholders' capital. And I would like to remind everybody that in Q2 2008, a very long time ago, the trust and my other fund, Property Growth and Income, were both 20% cash. That was the quarter before Lehman's went down. And many people asked me over the years, what made you so bearish? And quite simply, there was huge amounts of money being lent into the commercial property market at crazy rates, crazy margins, a lot of it going to high-risk development, just none of which we see today. And there literally, no one's going to lend you money on a speculative construction basis now. And you're not going to want to borrow it because you have no idea where your costs of construction are going to be in 6 months to a year, whatever. And the environment is very, very different. But it is a reminder that if my view changes, I will very rapidly reduce gearing in this trust.
So my final question for you, Marcus, thank you for your very honest and full answers to what I've asked so far. Just because you invest across the continent, you invest in the UK, but also a lot in Europe. In terms of the balance of where the assets are, which you're owning indirectly, essentially, has there been a significant shift? And what I'm sort of asking, I guess, is whether you think that with a lot of issues around the UK at the moment, particularly the political sphere, government sphere, and the wider macroeconomic problems, are you of the view that basically Europe is a better or worse place where your underlying money is going than the UK at the moment?
I'm afraid it is a better place, in parts. in parts. I would call out Southern Europe. We've increased exposure into Spain, into Portugal, into Northern Italy. We've also increased exposure into Central and Eastern Europe on the back of this surge of nearshoring, onshoring. We're seeing a lot of Asian companies coming to, if not avoid tariff and just supply chain management, to bringing a lot of manufacturing and finishing of products into those cheap parts of Eastern Europe to supply Western Europe. We are already aware of the benefits of the increase in defense spending. And we're seeing that through a business called Sirius, which is a UK-listed company run by a very good CEO called Andrew Coombs. And that business is a mixture of German workspace and also workspace in the UK. But all of his last capital raise of 100-odd million has gone into mainly defense assets in Germany. So that's been really interesting, where we've seen retooling of some automotive plants towards the defense industry. And then there are pockets all over the place. Logistics, industrial, in the Netherlands has been particularly strong as well. We're not the only country with political risk. The French have burning issues as well, but it does feel as though, there is a certain predictability about how the next 2 years, 2.5 years of this government is going to go. And that brings with it risk, essentially.
Yes, indeed. Well, we won't get into the politics of the UK at this particular moment, but it's certainly a factor that's on many people's minds, as how could it not be? So that was Marcus Phayre-Mudge, the manager of TR Property, talking to me on Friday, June the 12th. And a very interesting conversation it was too. So thank you, Marcus, for your comments.
Thank you, Jonathan.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.